Good morning. Mark Ostfeld from ADM ISI with a few thoughts on where we are at the end of this second quarter of 2019 and how markets have performed and how that may pan out or how it sets us up for the third quarter of the year. As one can see from my first table, we've got Fed rate expectations, which are basically pricing in a reasonable chance of perhaps even as much as a 50 basis point rate cut at the next Fed meeting at the end of July. And thereafter, we're still looking by the end of the year, but basically rates being down by 75 basis points, if not more. So that has been basically the tale of the quarter, particularly in the last month. That has been the driver of asset prices without a shadow of a doubt. If we move on to the next chart, what this is a comparison of the S&P 500 versus the VIX volatility index. As one can see, up until the moment that the Fed suddenly basically hinted at the fact or signaled a shift in its willingness to cut rates, we were having a less than fantastic time on the S&P 500, albeit one has to say we were just coming off a shade off all-time highs, and actually the scale of the correction that we had was not much. But in the meantime, obviously, we've had the hints of a rate cut, and we've gone back off to the races. And that's created a very subdued environment for volatility. Indeed, the spike that we had in volatility, if one looks at it in May, really was quite modest. Anything which is only just above 20 is no more than really a blip, and we're down back at 15. That volatility index is a point of concern, given that it assumes that basically we can carry on selling volatility till the cows come home, and I'm not really quite sure that that's a convincing argument in the scenario that we're talking about, basically that the Fed is taking out an insurance rate cut because there are a lot of risks to the global economy. We come to the next chart, in which has the yellow line is US high yield average bond spread, and the white line is the average investment grade bond spread. Again, it's not actually dissimilar, except sort of in inverted terms, to the performance of the S&P. So we saw substantial spread widening in both high yield and indeed investment grade. And we've seen some improvement since the Fed basically indicated it was probably willing to cut rates at some stage in the not too distant future. So let us move then on to the next table, which I think is the interesting one. Basically, we've also had a breakdown in the upward trend line that we've had since June 2018 for the US dollar index. Is the best gone by? Well, it really depends on what other central banks do at the moment. The likes of your Bank of Japan's and your ECBs are indicating a certain degree of willingness, though whether this is all rhetoric or not is a matter for some debate, to also cut rates, in which case the impact on the dollar should be relatively small scale depending on what the Fed does. And the Fed has actually given some quite strong hints in this last week that it's not looking at a large series of rate cuts. So we shall have to see how that pans out. But a weaker dollar has definitely benefited commodities. However, relative to where we were just back in September of last year, one can see that the commodity space is still under a lot of pressure. And most of that upward move that we've got there is primarily driven by a combination of gold and oil and corn. We then come to my final chart, US Financial Conditions Index. This is the GS version of it. I think the key issue here is the case is definitely not made for Fed easing, certainly not huge amount of Fed easing. Financial conditions are relatively speaking quite loose. We're back at where we were in the middle of last year when the Fed still had 2 more rate hikes coming through. And actually, when one looks at it, one wonders whether those financial conditions can last, particularly as we head into the Q2 earnings season. If we have a situation where the S&P 500 is at near the all-time highs, then one wonders really whether it's justified based on current metrics of basically the worries about the US economy. I'm not sure that this is really something which can be held onto for a substantial period of time.